Welcome to Capital Link's company presentation series.
Welcome everyone to Capital Link's corporate presentation webinar series. I am Nicholas Bornolis, president of Capital Link, and in this series, the senior management of listed shipping companies provide an update on their operations, business development, strategy, and sector outlook. In terms of disclosure, Capital Link is an investor relations firm. We're also active in event and conference organization, and we work with several private and publicly listed companies, including companies featured in this webinar series. As noted in our disclaimer, these presentations are purely for informational and educational purposes. They do not constitute investment advice or advice of any kind, and Capital Link bears no responsibility for them. We are privileged to have today, and it's a very timely, actually, presentation. We have the senior management of Ardmore Shipping. We have Mr. Anthony Gurnee, President and CEO, and Mr. Paul Tivnan, Senior Vice President and Chief Financial Officer. The whole session is going to last 45 minutes. We will start with a slide presentation, followed by a live Q&A session. And please submit your questions through at the bottom of the screen. You have the Q&A button, and you can submit your questions online, and this will be addressed after the slide presentation. Thank you very much for joining us. Also, you can email your questions to webinars@capitallink.com. And I will turn the floor over to Tony and Paul. Thank you.
Thank you, Nicholas. First of all, welcome everyone. Thank you for joining us today for this call. There's so much going on. We're going to try to keep our presentation a bit short so that we can spend more time on Q&A and cover the most current topics. Before we do that, let's maybe turn to slide 4 on the presentation, Paul. I think it's important to just address the Ukraine-Russia conflict up front. I think it's worth explaining what we know today, what we don't know, and I think most importantly, what is Ardmore doing? So what we do know is that we're in an unprecedented situation in Europe that hasn't been seen since the end of World War II. It's a watershed event with profound implications globally. It's an unbearable and deteriorating humanitarian crisis. What we don't know is the full extent of that crisis and its implications. We don't know what's the potential for further escalation and impact on, as has been widely discussed, geopolitical order, and the implications for the global economy, for energy prices, but also energy distribution and availability. So what is Ardmore doing? We're doing everything we can for our Ukrainian and Russian seafarers. However, that represents only about 2% of our staff. We're doing what we can more broadly for seafarers and civilians from our main office in Ireland. Obviously, Ireland is part of the European Union, and seafarers from Ukrainians are able to come to the EU for 3 years now. We are avoiding Russian cargoes and service providers, both from a moral standpoint, but also from a practical standpoint. And we're continuing to operate within the global market mechanism for product and chemical tankers. Given the rapidly evolving situation, I put this on the bottom here in case somebody's reading this later. You might find this presentation is out of sync with the realities at the time of reading, or even at the time that we're discussing this today. But we will cover this verbally during the presentation and provide you our views on what's happening on an up-to-date basis. Paul, could you switch to slide 5? Thanks. Okay, so our intention today is not to drag you through every bullet point, but rather just to hit the highlights here. I think the first point to make is that the MR outlook has changed fundamentally. Anybody that tuned into our earnings call will remember that we spoke a lot about the fundamentals looking good, but the oil market dynamics were holding things back. And for all the reasons that we had not anticipated and certainly hadn't hoped for, that the oil market dynamics have changed completely, and it's having a profound impact on the business. We'll also talk about fundamentals. I think it's worth just underscoring the fact that we continue to have a conservative financial strategy. We're financially strong with leverage around 50%. And we've got a consistent and focused strategy on products and chemical tankers. So I think Paul will cover this in more detail later. Turning to slide 6. So what's happening today? I think as a consequence of the Ukraine-Russia conflict, it's clear that product tanker rates are now increasing. And in fact, really from last week to this week, we've observed MR rates virtually doubling. The main drivers are currently just the simple fact that the oil market and normal trade patterns have been absolutely scrambled. Russian exports of crude and refined oil to Europe have been substantially reduced already. That might be a transition, but the question is where they're going to go. But in the meantime, they're already being replaced with seaborne volumes, both from the US Gulf and the Arabian Gulf. We're all watching the price of oil every minute, every hour. As we all know, it reached 14-year highs earlier this week. It's come off a bit. This obviously has a direct impact, not just on the distribution of the cargoes that we ship, but also the fuel that we burn. We'll talk more about the impact of bunkers a little bit later. But it creates a huge amount of volatility and market uncertainty. We were already dealing with relatively low product inventory levels globally. I think what's interesting is that people during the pandemic, buyers were running their inventories down, having a philosophy more around just in time, and that's been shifting to just in case. And as of the last couple of days, we see people really, stockpiling in particular diesel at the moment. So I think it's gone beyond just in case. People are, I wouldn't say it's panic buying exactly, but there's a significant run on diesel at the moment. What's interesting is because of the spike and then the drop in crude prices, along with the very high demand now for middle distillates in particular, refinery margins have now reached 20-year highs. And we're also seeing trading windows opening that are driving an increase in ton-mile demand. So that's kind of where look forward to discussing this more in Q&A with you. So let's turn to the company. A little less topical, but I think nevertheless important. This is our typical slide on what we do and what we're characterized by. I won't go through that in any detail. So we could just go to the next slide, Paul. So this slide normally goes in the appendix. We decided to move it up because I think it's important to just reflect a little bit on where we come from as a company. We started in business in 2010 with private equity backing. We IPO'd in 2013. And since then, we've gradually grown the fleet in a fairly disciplined manner, really from nothing in 2010 to a number of 31 ships under control at the moment, 25 owned, 2 chartered in, and 4 under commercial management. We intend to continue growing in a measured manner. Our focus is on products and chemicals. Most of our fleet actually is capable of carrying both products and chemicals. And so, one of the core features of our strategy is to play the overlap between those two sectors. Turning to slide 10, this is our fleet profile. As I mentioned, it totals 31 ships at the moment. And you'll notice that most of them are product and chemical tankers, meaning they can carry either category. You'll also notice that it's a relatively modern fleet. What you won't see jumping out at you from the page is that these are very fuel efficient ships. And I think if there's a time when fuel efficiency counts, it's certainly today. We're very, very pleased with the fleet, the way it's performing. And as we'll talk about later, the fuel efficiency of our ships is not an accident. I'll mention now that we've always focused very heavily on buying ships that are already quite fuel efficient and then finding ways to improve them, which we'll talk about later. Just to slide 11 there. Thanks, Paul. Yeah, so obviously ESG is a very important concept in the world today. It is for us, but we don't call it ESG. We think of ESG as a set of measures that people like you in the audience today use to judge companies. We also don't refer to it internally as sustainability. We think that's fine, but we'd rather call it progress. And more specifically, we look at progress and performance intertwined. So when it comes to environmental, for example, I think we're very proud of the record we have and the emphasis we're putting on this. But let's face it, the best way to improve yourself in terms of environmental performance is to be more efficient, reducing less carbon and other emissions, but also burning less fuel and improving your performance. So that's an example of where progress and performance for us are intertwined. I think on the social side, we benefit hugely from the diversity we have within the company on a lot of levels. And we take governance very seriously, and we hope that's appreciated by investors. On to slide 12. As I want to maybe make one thing really clear, which is that our feeling before the Ukraine crisis kicked off was that we were going from a period last year of a great focus on the energy transition to one toward the end of last year and into this year, where people were saying, okay, we also have to be realistic about this. And so it was energy transition versus energy realism. And I think we're now into a new phase, which is energy transition and energy realism translating into energy security. Now, that may not be as hot a topic in the US as it is in Europe, but I think it's on the top of everybody's agenda now politically and economically here. So that means that we think that the energy transition is actually going to accelerate, but it's going to go hand in hand with making sure that we have in that transition period fossil fuel energy security access to what's needed while these new technologies and new investments come on stream over still a relatively long period of time. But the fact is that shipping is under increasing regulatory pressure to reduce emissions, and we would rather not look at the regulatory framework around that, but rather the opportunity. So if you look on page 13 now, so where are we today? We're about 5% below the targets for EEXI, which is the technical measure, and we're about 12% below on operational measures, which is not just the Poseidon principles anymore. It's other measures as well. And as I mentioned earlier, this isn't an accident. We've always focused on buying fuel efficient ships, and then we're looking for ways to improve them. So without going into any detail, there's a schematic there from our progress report from last year, which has all the detail in it on what we've been doing to improve efficiency. Our energy transition plan, which we rolled out a little more than a year ago, involves technologies, projects, sustainable cargoes, as outlined here, and as anybody knows us probably understands this already. But again, if you look at our progress report from last year, this is all in there in detail. We have, I think a year ago, we made one initial investment, which in the grand scheme of things is not huge. It's $10 million, but it's also a joint venture to assist Element One in rolling out this new technology, which essentially solves the problem of how to get hydrogen on board vessels, ocean-going vessels, and coastal in a way which is actually quite practical. And on the lower right, you can see the first planned hydrogen-powered tugboat on the Mississippi called Hydrogen One, which is going to be powered by the E1 marine system. Moving on to other aspects of the company, this is a quick snapshot of our customer base. I think it's fairly typical on our business, but just to make the point that we're a global company and we operate and trade globally, and we have access to all the customers in the world. In terms of our organization, we have a global footprint that enables us to trade 24/7 and operate around the world. We decided to throw in a couple pictures of the teams that we have. Obviously, we like to have fun, but nevertheless, the Ardmore commercial team always means business, and the Corp team also always means business. So I think we enjoy what we do, we believe in what we do, and we've got a great team. Not a lot of gray hair in those pictures, but now you'll see more gray hair. Here's the profile of our senior management team. It's a good array of experience and perspective on the business that we're in. And on the next slide, we've got our board of directors, which includes some very interesting backgrounds from the industry as well as from the financial world. And other than me, it's fully independent. So I'm going to turn over the presentation now to Paul to take us through the fundamentals and demand drive, product tank and tanker demand drivers and industry outlook. Paul.
Perfect. Thanks, Tony. So let's start off with, as Tony mentioned, the drivers of demand in our business. I guess on the product side, first of all, there's three main demand drivers. The first one being increased oil consumption and oil consumption growth. So as oil consumption grows every year, more of it moves at sea. That's the primary driver. The second one, which we'll reflect on in the presentation in a slide or two, is voyage distances. And the main point there is refinery dislocation. So closures of refineries near points of consumption and moving the refineries closer to points of production. And the third driver is trading activity, which is really what we're seeing today. So increased price volatility, geopolitical tensions, and inventory imbalances regionally. And on the chemical tanker side, it's really a case of global GDP. We'll talk about that in a slide or two. But chemical tanker demand is highly correlated to global GDP. So starting with oil demand. So as you can see on the blue bars of the left-hand side, by about the second quarter of this year, we should be back to pre-COVID levels. And I don't think anybody knows the full implications of the Ukraine-Russia conflict. But the expectation is that by the second quarter of this year, we'll be back to pre-COVID levels. You know, the global economy was performing very, very well. But more longer term, IEA and others expect that oil consumption will continue to grow by about 1 million barrels a day through 2026 and beyond. That's as far as their forecasts go. But that's about a 1% increase in global oil demand. At a certain point, it'll peak out, but that seems to be further away than ever. So I expect oil demand to continue to grow for the next 5 to 6 years. And on the refinery dislocation slide, really the point here is that this trend has been going on for many years now, but you have an ongoing trend of closures of refineries in developed areas, the US, Europe, Australia, Japan, refineries that are typically built in the 1960s, smaller, maybe 100,000 barrels a day. And these are being replaced in great numbers, closed down and replaced by refineries, mega-scale refineries in the Middle East and Asia. And what that means, as you'll see on the next slide, is effectively, if you take a recent example down on the bottom right, there is Australia, a refinery in west coast of Australia, the Tivnan refinery, officially closed at the end of March of last year. That was a 150,000 barrel a day refinery. It would have imported a lot of crude oil, refined it at the refinery, and then moved to points of consumption in a truck. That refinery has since changed to an import terminal. So what that means is instead of moving crude oil into Australia, you're now moving refined products from Asia, from Singapore, from South Korea. And effectively, you're replacing seaborne crude oil movements with seaborne product tanker movements. And we estimate, it gets tough to kind of put an exact number on it, but we estimated every 100,000 barrel a day refinery, taking the Australia one as an example, could equate to additional demand for 10 MRs, which is not insignificant given the level at which refineries are closing over the last kind of 14 months or so. That trend had definitely accelerated as a consequence of the pandemic. Looking at chemical tanker demand, you know, the two largest consumers of chemicals, petrochemicals, would be the automotive and construction industries. So that's highly correlated to global GDP. So again, we don't know the true impact, or the full impact of the Ukraine-Russia conflict, but analysts had expected the economy to grow by 4.5% this year and a similar number next year, and that bodes well for the longer term chemical tanker demand growth. Moving on to supply and starting with scrapping, you know, in terms of supply, there's really kind of two elements to the equation. One is scrapping levels, and then the second one is new vessel deliveries and the order book. But looking at scrapping, first of all, we have two slides on this. The first one is scrapping levels in 2021. You can see that scrapping significantly increased for product tankers. This would be MR right through to LR2. The average scrapping age is between 20 and 25 years old. So that would be typically when a ship comes up to its fifth special survey, and then it's a critical decision point. So last year scrapping was very high for two reasons, I suppose. The charter market was quite weak, The fleet is aging, but more importantly, steel prices had been quite strong, so there was a good incentive to scrap the vessels at that point. So the trend on scrapping has been very encouraging, and we do expect scrapping to continue, primarily because it's an aging fleet, and as Tony mentioned earlier on, the trend towards decarbonization means that, you know, with the new regulations around CII and EEXI, means that it will be increasingly difficult to trade older ships, and particularly ships over 20 years old, purely because of their fuel consumption. As you can see on this chart, the green bars there are all eco ships. So anything built from 2013 would be eco and would be much more fuel efficient. But as each year goes by, you're starting to see the overall age profile of the fleet is increasing, and that alone would support kind of strong scrapping numbers over the next 5 to 10 years. And looking at the other component of supply is the order book. So the order book has remained at very low levels. As of today, the product tanker order book is about 6.1%, representing 175 ships delivering over the next kind of close to 3 years. On average, 60 ships a year, which is, if you recall from the prior slide, that's roughly in line with scrapping levels. And the order book for the chemical tanker ships is at a similar level, 100 ships. And we do expect ship ordering to remain low in the near term for two reasons. One is very limited berth availability due to a surge in orders. So people will know that the container ship market and the dry bulk market have been extremely strong, and that has obviously encouraged people to place orders for new vessels, mostly, you know, dual fuel ships, particularly on the container ship side. But more importantly, the lack of clarity on propulsion technology and emission regulations. So we still don't, you know, with a high degree of confidence, what would be the propulsion technology of the future. And that has dampened the willingness of tanker owners to really order speculatively. And for those reasons, berthing availability and lack of clarity on the propulsion technology, we think that new ordering levels will likely remain low for the foreseeable future. So all in, taking kind of demand and supply, you know, on the very first slide, we said that oil demand is expected to grow by about 1% a year. So that's the first leg of demand. And then you have refinery dislocation and you know, trading activity. And the second two of those, the voyage distances and refinery dislocation, we expect that added with oil demand growth brings you to product tanker and chemical tanker ton mile demand growth in the range of 3 to 4% per year. And that's been consistent for the last 10 years or so, and we expect that that's a pretty safe number going forward. And on the supply side then, net of scrapping, we expect the product tanker fleet to grow of between 1 and 2% for the next 2 years, possibly less if scrapping remains at the currently elevated levels. And the chemical tanker side, we expect fleet growth of less than 1%. So all in all, we expect demand growth to exceed net fleet growth for at least the next 2 years. Turning now to an overview of our financials. As Tony said at the outset, we've always taken a very disciplined approach to our balance sheet and to our business overall. In early 2020, in March of 2020, we introduced a capital allocation policy. I think we're one of the first companies, one of the first shipping companies to do it at least. And there we gave a very clear strategy on what we propose to do with capital. And the top priority is to delever. This is a cyclical business, and in our view, you know, debt reduction and getting your debt reduction down to a pretty low level allows you to be counter-cyclical and really build value. Last year, we reduced our leverage by 3.2%. We have a strong liquidity position at the year end of about $67 million. And that's really on the back of, you know, despite, you know, the charter market in 2021, we managed to accomplish that. And we did that in a very conservative and safe manner for common shareholders. And we issued a $40 million preferred shares at perpetual shares at a coupon of 8.5%. That's a highly attractive piece of capital, really boosted liquidity and enabled us to continue our leverage reduction. And this year we expect to maintain that level of debt repayments, repaying about $38 million over the course of 2022. We have significant earnings power across our fleet. You know, the charter market has significantly improved over the last couple of weeks, and not to kind of pick that as a point, but at rates as we saw in May of 2020, which was a period of high volatility, when your MR rates get above $20,000 a day, that is a pretty significant impact on our EPS. So if you could repeat those rates around $24,000 a day, you're talking of net income in the order of $80 million. So a lot of upside on this. Every $1,000 a day increase in rates across the fleet equates to 28 cents per share in EPS. And similarly, on the asset side, the ship values have been strengthening. You've seen continued demand for product tankers and for tankers in general. So values, as you can see on the left-hand side, have increased from December 2020 through to 2021 by about $3 million for an MR. And as you can see on the right-hand side there, we're currently trading at a discount to consensus NAV, analyst consensus NAV, of about $7. So we're trading at about a 35% discount, but every $1 million increase in investment values equates to about 73% or 73 cents in NAV per share, which is meaningful. We have a very high quality investor base. It's 100% free float. Approximately 60% of our shares are held by the top 20 shareholders. These are primarily long only rather, and many of whom have been with us since our IPO in 2013. So very supportive. We're certainly very grateful for their support, but a high quality shareholder base, which really speaks to their outlook and their support for the company. Again, we're very appreciative of the analyst coverage that we have. All the leading banks that are covering shipping cover the company, and again, very supportive of them, and they do great work. And with that, I'll turn it back over to Tony for some closing comments.
Thank you. Yeah, so I won't go through these in any detail. I think that what we've covered now in terms of the company profile and the industry outlook, I think still is important. I think the fundamentals, we just don't know how they're changing as a consequence of all this, certainly on the demand side. And we're happy to talk about that in Q&A. But I think the most important thing to point out is that because of the conflict, and it's probably going to have an impact on the oil market for quite some time, I think the conditions that were holding back the tanker market, at least the product and chemical tanker sectors, have fundamentally changed. And I think that that's going to drive performance going forward now. Thank you.
Thank you very much, Tony and Paul, for a great presentation. And we have an avalanche of questions. I hope we can address them all. Okay. So let me ask, following up on Tony's closing remark on the crisis, let me address to you one of the questions. Would a settlement of the Ukrainian crisis bring prices back down?
When you say prices, oil prices or freight rates or what?
I assume that the question refers to freight rates.
Yeah, so, well, okay, I think if we could, there's some kind of a strange feedback loop, but I'll keep going here. That's a really good question. I think it's very hypothetical because, neither side seems to be prepared to back down. Even if they were to come up with a settlement today, I think it's unlikely that sanctions that have been put in place and the self-sanctioning that's happening is going to change much at all for a long time. Let's not forget how much damage has been done to Ukraine in terms of infrastructure, the loss of life, arguably criminal acts against civilians, etc. So I think we're a long way away from the settlement and perhaps never going back to business as usual.
So another question is, at the current high price of crude oil, won't that negatively impact the near-term demand for oil?
Yeah, so this is very, very topical. I think we're all learning about this real time, and including very senior decision makers and governments and very large corporations, let alone Ardmore and investors. So one of our favorite oil analysts, Rystad, came out with a report this morning or yesterday with their initial assessment, and it's quite sobering. But also when you parse out the components of it, I think it becomes very interesting. I think we're all staring at the potential loss of 7.5 million barrels a day, from the world stage. But I think offsetting that will be demand destruction, interestingly, not just around the world, but specifically in Russia and the Ukraine, which they say will, could account for 1 million barrels a day at $130 a barrel. It's unlikely that Russian oil will completely leave the stage. So I'm really kind of addressing the question of, what in reality, how much is really required in terms of replacement barrels, and maybe that in and of itself is not as severe. When we look at just on the assumption that fundamentally Russian oil continues to flow, but it goes to more distant locations to buyers that are prepared to take it in, suppose in Europe, we think that could result for product tankers, MRs in particular, 3, 4, 5% increase in ton mile demand. And we think that at least offsets, probably more than offsets, any underlying loss of fundamental demand through an economic slowdown through this year and next.
Thank you, Tony. Staying on the same topic, and again, you've answered a number of the issues involved in this question. It says, between the Russia-Ukraine conflict and the potential loosening of the Iran and Venezuela sanctions, there's clearly a lot going on right now at the geopolitical level that could have important impacts on product tankers. So how do you think about the most significant potential impact on your business, and what, if anything, are you doing to prepare for it?
Well, very good questions. So all the discussion around what is we can get that feedback loop. But anyway, that's fine. I'll keep going. So all of the picture down, but anyway, all these increases in crude oil production are, of course, crude oil, and then the question is, that goes through a refinery. At the moment, I think I mentioned that, because of the current conditions, refinery throughput is probably going to increase substantially because the margins have widened so much, and that's because there's so much demand pull at the moment. I think there's a great concern, especially with middle distillates, that Russian barrels leave the stage. So I think for us, it's really a question of where do replacement barrels come from, to the extent that Russian products, kind of are no longer available. So that's a bit of a noodle soup there of an answer, but I think that we're currently in a phase of very, very significant volatility, not just when we look at Brent and WTI, but local physical oil prices around the world, which is really, driven by physical shortfalls and surpluses. So that it's like blowing smoke into a hornet's nest in terms of creating activity for our kind of ships. We always talk about our ships as being the taxi cabs of the oil business, and it's like something very disturbing happened in New York. The taxis are going everywhere right now, right? So, but I think the rush on diesel at the moment is significant, but other products as well. So we just fixed a ship to carry UAN, which is a fertilizer, from the U.S. Gulf to Europe. Of course, a lot of UAN for Europe comes from Russia and Ukraine, and obviously, given the time of year, there's going to be a scramble to get that kind of product into Europe as well. So it's not just gasoline, diesel, jet fuel. It's other things that are made from natural gas, made other petrochemicals as well.
So that leads in a way into the next question, focusing on your business. Moving forward, how do you think about the balance between MR2s and chemical tankers in your fleet, and what about the balance in your cargoes?
Well, really, for the last couple of years, when we analyze the cargoes opposed to ships themselves, it looks like roughly 25% of our cargoes are non-CPP. Very long term, I think it's beyond anybody's time horizon that's on this call. We think that the real demand growth in liquid bulk transport, which is the business that we're in, is going to be non-CPP. It's going to be veg oils, biodiesels, petrochemicals, inorganics, etc. And so that's gradually where we're going to be heading. So I think that strategically that's where we'll head, but we're driven every day by trading decisions to optimize our performance, ways to improve our fleet, both the ships we have as well as the fleet profile, to have more cargo trading flexibility, so that as these growth and higher paying cargoes come along, we can take advantage of it. So it's the direction we're heading in, but we're also not afraid to charter in pump room ships at attractive levels, because we think that's absolutely required by the global economy, and we can do well with those.
So moving on to decarbonization and environmental compliance, how do you expect EEXI regulations in 2023 to impact Ardmore in particular, and also the overall landscape more broadly?
Maybe I'll start and then ask Paul to comment as well. I think it's on the one hand, it's all great that we have these regulations in place and they're going to gradually tighten. I think what's disappointing is that they're going to take a long time to have real teeth. So I don't think that it's going to very rapidly drive ships off the stage. What could happen though is these measures will be out there in full public view, and if you have a ship that belches a little smoke and trails a little oil as it moves along, none of which are in our fleet, but those kind of ships are going to go away, and I think more importantly, charterers are going to shun them. So I think the discrimination could result in, it's a cliche in shipping to talk about 2-tier markets, 3-tier markets, but I think that those ships will be marginalized. So I think on the margin, it certainly helps. But again, we don't really worry about the regulations. We look at as the opportunity to basically earn more on our ships by being more fuel efficient and appealing to the top quality charters in the world.
Yeah, as I think about that, Nicholas, your pressure comes from 3 places. One is the regulations. The second one, as Tony said, was customers, but also you have to think of your financiers. So you can't, the pressure may come more from one angle from another. So as Tony mentioned, charters and customers ultimately are probably going to demand more from shipping and to kind of do as much as they can and really maybe accelerate beyond the regulations. But likewise, financiers, you can see particularly the Western banks, whether it's signing up to Poseidon or most general, their overall, not just shipping, but real estate, everything, they're under pressure to reduce carbon in their portfolios, and shipping is a part of that. So, good companies with good fleets will find access to financing, and other ones might not. So I think you have to look at pressures from all 3 sides.
Indeed. Now, staying on the decarbonization topic, what impact do you see the Poseidon principles and similar other initiatives having on the industry, and what specifically are you doing in that context?
Yeah, I mean that's a great question. I think Alina just mentioned if people can kind of mute their cell phones, that might be giving the feedback. But I think I might have half answered that question earlier on. But yes. I think the Poseidon principles, okay, was a great initiative. It's the banks really stole the march and really were the first to act on the decarbonization. That was in 2019, early 2019. Then in the summer of 2019, we were actually one of the first companies to start reporting our carbon emissions on a quarterly basis. And at the time, there wasn't much guidance. The data was, a little bit all over the place. But we said, look, we need to do this. We need to try and, in many ways, take a leadership role here. And over time, we can improve the data. We can improve it. And then it eventually means something. And then fast forward 12 months later, we did a financing with ABN AMRO, and that became important because sustainability measures were in. They wanted to see that your AER was trending below Poseidon, but also wanted to see your performance on other measures, on your diversity, on your progress. So in terms of the impact of Poseidon on our business, again, Tony mentioned that we look on these as opportunities, and that's exactly the case with the financing. And we look forward to it. Now, what I will say is the first couple of percent below Poseidon is easy, and the next couple of percent will be harder. So all it can do is really improve the industry in terms of cleaning up and decarbonizing. So we're supportive of it. We jumped on it quite early, and we think it's a great thing for the industry and for financing. So
going into again, continuing on your profile. One of the questions we got is, what is the current chartering strategy from a spot versus long-term charter coverage perspective in the current environment?
I just turned off my own phone. That might have been the problem. Okay, so last year, call it lucky, call it smart. A year ago, we put a number of ships, 5 ships, which for our fleet is this given percentage on time charters at over 14,000 a day, and that was certainly a nice buffer through the year. They've actually all run off now. In addition, we've got 2 other ships chartered in. So we currently have 27 ships fully trading spot, and we've got the earnings or the service fees from the other 4 ships that we're commercially managing. So we've got good exposure to the market now, and we're happy with that, given where the market is right now. Again, I want to clarify every time we say happy or whatever that we're kind of devastated by the consequences, what this is resulting from, but the market's the market. So I think one of the other questions was where are rates now, and why are we happy to be spot? So literally last week, so I think if anybody in the audience spends time looking at shipbroker reports, and you look at all the indexes for the different routes, what we've been doing for the last couple of weeks is stripping out the Baltic and the Black Sea runs and look at the actual Arabian Gulf East or US Gulf to Europe, those kind of things, or South America that aren't directly infected by the self-sanctioning sanctioning. And crude tankers are continuing to have a hard time. Aframaxes are doing the best there, up in the kind of mid-teens now, it seems, maybe a little bit more. LR2 is doing better, as most people know here, I'm sure. An LR2 is a coated Aframax, but they're in the low 20s right now. Then you have LR1s in the high teens, maybe low 20s. And then MRs have, again, if you strip out those runs, we're probably in the high teens now globally. That's the market. What I will say is the ships that we were fixing last week versus this week, we've gone from 13,000 a day to 25,000 a day. And, again, we don't have a huge fleet, so it's not like an enormous data set, but it's, that's a fairly, it's at the moment, Europe is still a little bit weak. Asia is improving, Arabian Gulf is strong, and the US Gulf is very strong. So it feels like we're in a $20,000 a day plus environment now, or at least, kind of heading into that. And that I think if you put it in context of the other product tanker sizes, that's about right. So it makes sense. Where it goes from here, so I'll leave it there.
So the last question to ask you, capital allocation is one of the favorite topics, I think, in the industry right now. So we got a question. Could you please discuss about free cash flow reallocation priorities between number 1, addition to the fleet, number 2, deleveraging, and number 3, shareholder returns through dividends and buybacks?
I'll start and then I'll hand it over to Paul. We've been through a very, very tough 2-year period. We were in a tough period before that. So it's been hard going in our sector for quite a long time. And I think that we are going to continue to prioritize recapitalization, debt pay down in the near term. I think if you look at other sectors like container shipping and dry bulk, I think this discussion has changed very, very substantially over the last 2 years. And, who knows, that may happen with the tanker sector as well. And Paul, do you want to add more to that?
Yeah, I mean, again, a point I made earlier, back in the early 2020, we took a really hard look at this. Not just, we had a dividend policy, but not just a dividend policy, but overall capital allocation, because dividend policy or share buybacks is just one component of share capital. So we took a hard look at it all. We looked at some of the top companies out there in cyclical industries to see what they were doing. And out of that, then we initiated our capital allocation policy, which set out 4 priorities. And the first one is to maintain the fleet. So when we talked about continuing to invest in the fleet and reduce fuel efficiency, that's the first thing. The second one is to reduce our debt to cap to below 40%. The third priority then is accretive growth. So if there are opportunities in front of us that can, build value without issuing shares or whatever, if there's ways to continue to make more value with what we have, that's the third priority. And then after that, we can look at returning capital to shareholders, whether that's in the form of dividends or in the form of share repurchases. So we've been very clear on that. I think it's well articulated. And I think it's consistent with what a lot of the other companies are doing today on the container ship and dry bulk side. And as Tony mentioned, hopefully that the day comes around for us that we're able to get to that point that we can return rewards to shareholders.
I'll just finish on that point by just adding that it's something we take seriously and that we discuss with our board at every quarterly meeting.
Well, we have come to the end of our session. I would like to thank you both for being with us. Before we close, if you have any final remarks.
Just to say that I think, obviously fundamentals count, and I think company profile is important. What I think we're all, learning real time now is what the impact of events are on the market that we trade in and in the oil market more broadly. And I think it's changed completely in the last month.
Well, thank you again. This presentation will also be available for a replay, and we have good attendance, an avalanche of questions, very interesting insight, and thank you both very, very much for being with us today.
Thank you.
Thanks, Nicholas. Thanks, Chief.